Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Justin Carbonell and Jack Forehand are principals at VALIDEA Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of VALIDEA Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of VALIDEA Capital.
Hey guys, this is Justin. In this episode of Excess Returns, Jack and I talk about some strategies investors may consider to help limit downside risk in their portfolios. The market's historic move over the past 15 months, coupled with increasing market volatility and signs of inflation, have some investors looking for ways to protect profits and try to limit downside risk. From active portfolio rebalancing, asset class diversification, looking to where there may be relative value in the market, hedging using tail risk and other strategies, and even modifying your RMD withdrawal timing approach could be ways to help protect your portfolio and profits. But these changes also come with their own set of potential shortfalls, and it's often best for investors who are making these changes to make small adjustments around the edges, and also to stick to their long-term plan and their investment allocation. Thank you for listening. We hope you enjoyed this discussion. Okay, today we're going to talk about the idea of how an investor might protect their portfolio and potentially some of the profits that they have in their portfolio, given just how much the market has come back over the last 12 to 15 months. This sort of idea for the article I wrote and the podcast, our discussion today, actually came from a number of conversations I was having with investors around different strategies and methods on how to protect their investment portfolio. And so what I tried to do here and what we're going to talk about is a number of various things that and I guess moves in your investment portfolio that one may consider that might be able to help deliver on some of that de-risking of a portfolio if the investor feels like that's the best thing for them. But maybe just before we get into that, I also put this in my article, is that each one of these decisions comes with, it's not a guarantee that what we're going to talk about, these things could actually de-risk or lower risk. On the surface, it's going to seem like they have the ability to do that, and they certainly might. But the point that I'm trying to make is that anytime you make sort of changes or adjustments to one's portfolio, it doesn't necessarily always mean, even if you think it's a risk-reducing thing, it doesn't always mean that it's going to achieve that goal. But I think some of the things we're going to talk about will probably mostly do that. It's just never a guarantee, of course, with any of this stuff. So to start, Jack, I know we want to talk about this idea of the difference between, I guess, risk in the academic world and risk in the real world, and sort of how we might go about thinking about that to sort of set the stage before we get into some of this stuff.
Yeah, so when you think about this in the context of like the academic argument, or the facts that are behind the scenes here, if the stock market has a run like this, or if any time, if there's uncertainty in the market, whatever's going on in the market, and if you have a long-term portfolio that is set up appropriately for your long-term goals, what should you do in a situation like this? The answer is nothing. Whether we've had a big run or we're seeing additional risk in the market, the answer is you should stick with that portfolio, because timing the market is so difficult. And typically, when you try to time the market, you do more to hurt yourself than you do to help yourself. And what we've learned managing money over the years is you can't just have that hard and fast, you should never do anything rule, because people have emotions, people have biases, people have things that influence what they're doing. And so what you want to avoid here, the worst case scenario, when you see any sort of market environment present itself and you say, do I want to make changes? The one thing you want to avoid is the binary choice. The binary choice is what kills people. Right now, as we're talking, we've had a lot of volatility in the last few days. The binary choice would be, all right, I'm panicked, put my portfolio in cash. And that type of change almost always has a major negative effect on an investment plan. And so the better thing to do, and this is sort of what you're getting at in the article, the better thing to do is maybe to look around the edges and say, are there some minor, if a client or if a person is feeling this way about the market, are there some minor adjustments I can make? Are there some tweaks I can make here that might allow an investor to stick with their portfolio, even though that's not the perfect thing in the academic world, because sticking with your portfolio is much better than making one of these in or out type decisions.
One of the examples I gave in my article was that if you took an investor, let's say that was 50-50 stocks and bonds at the end of 2019, So they come into 2020 with that, let's say, target allocation. Let's even say they rebalanced back to that because that's where they wanted to be in terms of their allocation between stocks and bonds. Effectively, the market would have dropped 30%, assuming there was no changes made. But now, as it's come back, that allocation would be more like 65, 70% equity, and the bonds would be a lot lower. So in that case, the stocks have done so well that they're kind of far from their target allocation. And what the risk of that is, if the market takes a downturn, now they're going to have more stock exposure relative to their bond exposure, assuming that they're, the bond do what they should do, which is hold up better than stocks in a downturn. That type of allocation being so far, away from the target, it might not be the best thing for the investor. So one of the ideas I had, and what I also did is I showed, and it's kind of a different concept, I guess, but we're sort of blending this rebalancing and diversification sort of conversation together. But in this section of my article, I also had a table going back to 2012 of all the different asset classes and their performance. And I show, so it's showing US stocks, Japanese stocks, European stocks, high yield bonds, REITs, emerging market equities, cash, commodities. And so I was kind of trying to use this idea of sort of diversification, but also rebalancing back to target weights when they get so far out of whack as examples of things that investors should be thinking about and potentially doing with their portfolio. Again, on the edges, but these are just, that's just one idea to help maybe reduce some risk in the portfolio.
Yeah, and rebalancing is a great way to do it without getting into the whole market timing idea, because rebalancing is basically just getting back to where you wanted to be in the first place. And one of the things I think is really important with rebalancing is to have some sort of systematic process to do it, because if you start trying to figure out, picking and choosing when you rebalance, then you put your emotions back into the equation. So, I think there's two interesting ways to do rebalancing. One is you can just have sort of scheduled times you do rebalancing throughout the year. Or the other one is you can have sort of bands around your portfolio. And so if your stock and bond allocation gets more than X% out of whack, you'll do an automatic rebalancing back. So I think both of those make sense, but I think I think rebalancing is a great way to do this, but it's probably good to have like a systematic process about it. So you're not just, picking and choosing what days you're doing it.
One of the other things that this chart showed, and we'll actually put this in the podcast, I'll drop this in just so investors can see. And I'm just making this as a point, but US equities over the last 10 years, and I believe this is just like US large cap, have returned 14.3% annually per year. The next asset class in terms of the number second spot, the second best performer is REITs at 7.5%. And then from there, everything else is below it. And by the way, commodities are negative 5.4%. So, it's been a great decade for US stocks, and US investors that have been, largely in the market have certainly benefited from that. But I think if you were to roll this return table back, 10 or 20 years, you might still see US equities on top, but commodities certainly have had periods where they've had better runs in there, and some of these other asset classes. So that's just another thing to keep in mind, that US equities have done very well, things like commodities haven't, but that sometimes allocating strategically to the areas that haven't done well can be good as we think about future returns.
And also, as you look at the potential for inflation in the future, that's something we hear from investors a lot about. If the risk you're worried about is inflation, then there are changes you can make around the edges where maybe you don't just hold stocks and bonds in your portfolio. Maybe you hold some assets that would do well in an inflationary environment. We're not necessarily rotating tons of money towards that, but you can make that one of your positions. And so you can protect from that type of scenario if that's what you're concerned about as an investor by putting some of those assets in a portfolio and not just having stocks and bonds.
These next two topics are a little bit more active in nature. So we're sort of talking about, just a few minutes ago, this diversification, rebalancing. Those are sort of higher level investment decisions that investors can make. But the other thing I pointed to is the title of this part was Look at the Laggards. And this is something you've written about, how high quality stocks have underperformed low quality stocks really over the past few months. And I put a chart in the article that showed periods of time when profitable companies in the Russell 2000 value beat the unprofitable companies, and periods when unprofitable companies beat profitable companies. And we're certainly in a period where unprofitable companies are beating profitable companies. And so my idea here was, for the active investor that is, sort of allocating to equities based on that have certain characteristics, it might make sense to look at these highly profitable or high quality companies in the value segment, and kind of lightening up on these unprofitable ones if that's where you've been in the market.
Yeah, this is a solution to the whole problem of, and this also applies to tech stocks, not just these low quality value stocks. I have a big position in X type of stock. That stock has had a massive run. That type of stock has had a massive run. How do I deal with that problem? And one way to deal with that problem is just to say, don't put all your eggs in one basket. So obviously, whatever this is you've invested in is done really well, but there's something on the other side of the coin that you also could buy. So if you have a lot of low quality value stocks, you can rotate into some higher quality value stocks. If you've got a lot of FANG stocks, maybe looking at value in general is a good idea. Spreading your bets across different things that might work in different outcomes in the future is a good way to look at this. If you're worried about a certain type of stock that you've had that you've had a very large return on.
One of the innovations, well, there's a lot of innovations that are happening in sort of in the ETF space, but I talked about this concept of hedging and buffering. Again, this is more of a direct, I guess, a direct play on, trying to somewhat time a decline, or maybe that might not be the right word. It just might be, adding some strategies or vehicles that would go up if the market goes down. And I use the example of the tail risk ETF there. And then there's also ETFs that use out of money put options on the market, so they can offer some tail risk protection. And then, there's even other strategies that have this buffer built into them. So they're basically offering protection against certain losses in the market. Like maybe they'll protect against a 9% or 15 or 30% loss, but then they're capping the upside as well. And those are known as buffer ETFs. So those might be some vehicles that investors can use strategically to sort of hedge out some of this market risk if they think the market's really expensive, and they're willing to maybe give up some upside if they get it wrong.
Yeah, one of the cool things that's been going on with all the innovation in ETFs is a lot of these strategies that maybe would have been more institutional strategies in the past are now available to individual investors. And so what you don't want to do with these strategies is some of these strategies can be very complex and very risky. So, some strategy that's double short the S&P 500 or something, or that, that just owns options or something like that is probably not the direction you want to go. But this, you mentioned the Simplify ETFs. That's a good example of something that's innovative and that might make sense for some investors. What that is the Simplify ETFs hold the S&P 500, but they also hold either out of the money put options, out of the money call options, or both, along with the S&P 500. So you continue to have your normal market exposure, but you have tail risk protection. If you want tail risk protection on the downside, they have one that just does that. They have one that has tail risk protection on both the up and downside, and one that has tail risk protection, for the upside. Basically, if you think the upside is going to really run, you can do that as well. So that's just we're not recommending any particular products, but that's just an example of the types of things that are out there now. There's risk parity ETFs now. There's a lot of things out there now that investors can look at, maybe if they want to get away from just having their market risk without any hedges whatsoever that they can use.
I had two elements of timing in here that could be utilized potentially to address this. One was, and I'll let you kind of speak to both of these, but one was the potential increase in long-term capital gains rates for high earners and ultra wealthy people that has been proposed by the Biden administration. That might play a role in timing some changes in a portfolio. And then I also sort of just highlighted this dynamic RMD, required minimum distribution strategy, where an investor might decide to take the RMD earlier in the year. Now there's a risk to that. The market could continue to go up. You could have a melt up and you could be leaving money on the table. But for an investor that, feels like the market, there's more downside risk and would be worried about that, and it, may have bad behavior during that period, it may make sense to take the RMD now while stocks are doing really well, rather than wait until the end of the year, which when a lot of investors do it.
Yeah, we're certainly far from tax experts, but the tax situation has been very interesting during this whole run because, one, you had this compressed, period where the market went up a lot. And so you had a lot of investors sitting on short-term gains and sort of balancing holding these until they become long-term gains with maybe some sort of risk management. And then you have, like you referenced, the possibility that for a certain a certain type of investor that has a large income and a large portfolio, that their tax rates, their long-term gains may be taxed as short-term gains, starting in maybe 2022. And so that's just, we're not tax experts, so we can't, necessarily have too many opinions on that one way or the other. But it's a very interesting dynamic that we've sort of been dealing with clients this year about, well, what do I do? I'm worried about the risk. I've had this huge run. I want to wait till my gains are long-term. And then on the flip side, once my gains are long-term, might want to take my gains, because now I'm worried about, if I take them the next year, the tax rate's going to be much higher. So it's just something to consider. I mean, obviously everybody's situation is different, but it's a very unique situation going on right now with that.
Yeah, and like I pointed out in the article, a lot of these things we're talking about, if you are going to do these, if they're in taxable accounts, there would be some taxable transactions that, if you're going to change your portfolio, basically, that you got to keep in mind and be aware of. Obviously, if it's retirement account, you don't need to really worry about that so much.
Yeah, I think just to sum up everything we've talked about, I mean, there's always going to be risks in the market, and there's always going to be things to worry about, and there's always going to be uncertainty. And, the thing we said at the beginning is usually the right answer. And usually the right answer is, if you have your portfolio set up with a long-term allocation that makes sense for you, those risks will work themselves out, and trying to adjust it in response to what's going on in the market is typically not a good idea. But if changing your portfolio is going to prevent a major mistake, or if you see one risk that you're really, really particularly worried about and you want to make slight adjustments to deal with that risk, a lot of times that's a better answer than, panicking at some point in the future and going all the way to cash or making some sort of major change. So, I think it's definitely a long-term balance here. But these are, you had some really good ideas in the article in terms of things, if people are trying to do things around the edges, if they're not trying to make major changes, this is a good checklist of things you can look at and things you can consider.
Great. Thank you very much. I think it's a great way to sum it up. So thank you guys for watching, and we will see you next time.
Thank you.
Hi guys, this is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at JJCarbonell. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.